Today, I want to talk about the statement on monetary policy. No, that's not what Michelle Bullock, the governor, gave us last Tuesday when she told us that interest rates were going to go up. The statement on monetary policy is a much larger research paper that's provided by the RBA on a quarterly basis. And it tells us not only just the outlook for the world economy, but in detail and most importantly in this discussion, it tells us about where the RBA thinks that growth, unemployment and inflation are going to be in the Australian economy this year, next year and the year after. And the reason that's really important, and so when it was released on Friday, the 10th of November, is that under the new order of business that the RBA is running with, really from now, but officially from January next year, this statement has increased emphasis. And it has increased emphasis similar to the summary of economic projections, which is published by the Federal Reserve every quarter. Now, the reason it has increased emphasis is we remember the terrible trouble that the previous governor of the RBA got into, providing something called forward guidance. And in forward guidance, Mr. Philip Lowe, PhD, former governor of the RBA, said that he thought, this is a few years ago now, said that he thought that interest rates wouldn't go up for the next 4 years. Now, he said that at exactly the same time as Jay Powell said the same thing from the position of the Federal Reserve. But the problem was that in Australia, the Australian cash rate has a much closer relationship to borrowing costs for housing than the Fed funds rate has to long-term mortgage rates, for example, in the US. So this problem of providing forward guidance became a political problem in Australia that it wasn't anywhere else, and now the RBA is reacting to that by throwing increased emphasis on the outlook provided in the statement on monetary policy, and particularly on the quarterly outlook provided therein. Special attention must therefore be paid to table 5.1, which is in the last section, one of the last sections of the statement, and it's an economic outlook. And this table 5.1, outlook of growth and inflation forecasts, shows a whole lot of numbers on it, on all of those things, inflation, outlook, unemployment, and going forward for the next 3 years. But what it interestingly does is it doesn't just show their forecasts, what they are this time, it showed what their forecasts were last time. And there are differences between those two on this occasion. For example, these differences are the key to the tasks that the RBA is giving economists under this new regime. We see that GDP growth in the document for December 23 is 0.5% higher than expected 3 months ago. So the economy is stronger than they anticipated. CPI inflation is also 0.25% higher. But by the time we get to the middle of June, inflation is 0.5% higher. Now that's really important. If you're a central banker, you've said inflation is going to be higher than anticipated. It's going to be 0.5% higher than anticipated, because that means it's half higher than you anticipated back when you previously were setting monetary policy based on this other forecasts. Now, central bankers treat short rates as a real rate. You've got to have the same real rate, target the same real rate, at different levels of inflation, and that means that if the inflation goes up, the nominal rate goes up that you've got to quote, and that keeps the real rate the same. So this means that the higher real inflation suggests that the RBA now Remember, we're not allowed to have forward guidance anymore, but it suggests very strongly that cash rates are going to go up. And a prudent bet would be that the real cash rate will rise, or that the cash rate will rise in order to keep the real rate stable by 0.5% over the two meetings in November and December. Now, we've had 25 basis points in November. And yes, this means that I'm forecasting another rate hike in December, and that will bring them up to their forecast. Now, the reason for all that is, and you'll see a chart in the video version of this presentation, is that the economy is stronger than expected. And the reason the economy is stronger than expected can be identified by looking at the terms of trade. And the terms of trade tells us the level of export prices divided by the level of import prices. So even though export prices have come down a little bit, what's remarkable is we get most of our imports in Australia from areas of the world in Asia, which didn't have an enormous amount of stimulus during the pandemic, and therefore didn't have that enormous amount of inflation. So that means those imports that we're getting from those countries are really cheap, yet our prices of what we're getting are still very high. So that means that our terms of trade is very high, and we're generating an enormous amount of national income. And this is providing enormous stimulus to the Australian economy. And as I say, truly, we remain the lucky country. There is another issue that the RBA raises towards the end of the quarterly statement on monetary policy. And this is in a section which is the very end called Box B. How's that for a bureaucratic name? Box B. And the question is, has the economic outlook evolved as forecast a year ago? We've already found out that it didn't. But from what we've learned earlier, and we see that, and they go on to quote here, that population growth has been stronger than anticipated, driven by a large increase in net overseas immigration following the reopening of the border. And they go on, and I quote, but the net effect of the unemployment rate and aggregate inflation have been relatively small because of the small increase in population has added to both supply and demand, which is exactly right if you were just talking about the labour market, because there was high demand in the labour market, higher supply in the labour market, and that meant that as a result of the higher level of immigration, the labour market was in balance. But that's not what's really important about this. I think what's really important is what they haven't spoken about. And that is, when we look at the total demand of the economy, we must remember that once a permanent worker with a full-time job, then the reason that we're importing these people, we're importing them on higher salaries because they're filling gaps in the Australian economy. So once a permanent worker with a full-time job qualifies for a housing mortgage, that worker adds many times the annual compensation to total demand. Matter of fact, you're funding the building of a whole house, you've got a number of times the annual compensation. So we think that increase in what is literally structural demand by accelerating immigration will generate much more demand in the Australian economy than the RBA appears to suspect. And so we think there are the opportunity for further upside surprises to the RBA on growth and inflation are excellent. And these surprises will be courtesy of the lucky country.